Okay, we are recording. Hello, everybody. Good morning. I am doing this recorded lecture for Chapter 4. Already in class, I've mentioned kind of where we're going in Chapter 4. We're going to the next steps of the accounting cycle. And so I do want to show you that, and then we're going to go through the PowerPoints and, of course, get practice with these things in class together starting next week, right? So I'm going to share my screen with you. And at first, I want to pull up this chapter 3 problem that I did in the last recorded lecture. So in the last recorded lecture, and we were doing this in class together as well, we worked on this problem, right? Problem 3.3b. And so I went through and we did the journal entries. And then once we did all the journal entries, we posted all the transactions into the accounts. And then once we got all the transactions posted and the balances updated, we prepared the trial balance, right? That's what we prepared here, the trial balance. So, this is what you have to do or had to do for your Chapter 3 homework. And so we said, again, doing the journal entries like this. Remember, step 1 of the accounting cycle is analyzing transactions. Step 2 is journalizing transactions, right? So these journal entries really represent step 1 and step 2 of the accounting cycle, right? And then posting the transaction. So, for example, when we see the credit to cash right here for $1,520, here's the credit to cash for $1,520, which brought our balance down to $3,048, right? So we're posting the transactions, updating the balances. That's step 3 of the accounting cycle. And then again, and we have to do that for every journal entry, right? And then once we have all the accounts updated, all the balances updated, step 4 of the accounting cycle is preparing this trial balance. So then we did this together, right? So in Chapter 3, we went through the first 4 steps of the accounting cycle. Okay. So now looking at this trial balance, we can get, and I'm just going to put this on its own thing here so we can look at it. Oh, geez, Louise, of course it looks funny when we transfer it over. Okay, well, then it's just pasting the values. I know it looks a little bit different when it transferred, but basically, we're looking at this trial balance. We can look at a couple of the accounts that we would normally adjust, because that's where we're going. So again, step 4, this trial balance, step 4 of the accounting cycle. The next step 5 of the accounting cycle, are adjusting entries, right? Step 5 are adjusting entries. So step 5, we would do the adjusting entries. We would update the adjusting entries to the T accounts, and then we prepare another trial balance. So that's the next couple steps of the accounting cycle, right? So some of these accounts that we would adjust normally. So supplies, this is one. So if you think about it, these in this problem, these were July transactions. So we bought these $320 worth of supplies at the beginning of the month. And now we're to the end of the month and we no longer have $320 worth of supplies left. We've used up some of those supplies. So we need to adjust this account for the amount that has been used up. So for example, again, this $320 in supplies. This could be maybe, packages of paper, maybe ink cartridges for the printer, maybe Post-it notes, pens, pencils, whatever. And so then we get to the end of the month, we've used some of that up. So we need to count, we need to determine what we have left in inventory and adjust that account. So, for example, if we have 250 left in inventory, then we would adjust account for $70, right? if the current account balance is 320 and we have 250 left in inventory, then we would need to adjust that account for $70. This prepaid insurance, this is also another common adjusting entry. Because if you think about it, when we prepay this insurance, and I know that prepaid insurance had a beginning balance in this problem, and then we purchased another $2,600 worth of insurance, right? If we go back here to this journal entry that we did, prepaid insurance, if we go back to this, this was for purchasing a 1-year insurance policy, right? So if we paid $2,600 for 1 year, if we take $2,600 divided by, oh, come on now, let's get our little divided by sign here. Divided by, oh geez, 12. That equals, so equals 2,600 divided by 12. That means that our insurance is $216.67 basically per month, right? And so we purchased this insurance policy in the beginning of July. And now we're to the end of July. We no longer have 12 months prepaid. Because 1 month has passed. We only have 11 months prepaid. So we would need to adjust account for month that has passed. Right? In that situation. Equipment is another one. We do an adjusting entry related to equipment, and this is in relation to depreciation. So the adjusting entry here is for depreciation. And so what happens, and I don't know if we have touched on, I think at least, we've touched on maybe depreciation, but, depreciation, essentially the asset, in this case, equipment asset, loses its value over time, right? As we use up that asset every year, it loses its value over time. It depreciates in value over time, right? And so companies get the benefit of depreciation expense. And if you think back to our income statement, revenues minus expenses equals net income. Okay, so depreciation expense, just like our other expenses, we take revenue minus expenses, that equals net income. So, if we have depreciation expense, that's a tax benefit because it's going to decrease net income and then in turn decrease our tax obligation, right? So that's a good thing. And so when we think about equipment overall, as we go through time and we depreciate the asset, the book value of the asset drops. So if we think about right now, this equipment has book value $22,960. If we do not purchase any other equipment, if we just only have this equipment, we don't purchase any new equipment, this number will be less next year because we will have depreciated some of that asset, right? So then that's another common adjusting entry. The other one, which is not here on our trial balance, is unearned revenue. That's another common adjusting entry because if customers prepay us in advance and then every month we earn a little bit of that revenue, we have to record it and we have to switch it from unearned revenue to earned revenue, right? So anyway, I just wanted to point out a couple of those common adjusting entries. Of course, we're going to see examples of this in the PowerPoints as well. We're going to get practice in class together. Okay. Hi there, everyone. All right, let me pull up now. So we got that. Let me pull up our Chapter 4 PowerPoints and we'll start going through these. So again, Now in chapter 4, we're getting into adjusting entries, and then basically going through the next few steps of the accounting cycle using a worksheet. So chapter 4, and I just showed you a couple examples of those accounts that we have to adjust at the end of the accounting period. So now we're going to look at that in chapter 4. So the first thing that the chapter touches on is the difference between a fiscal period as opposed to like a calendar year. So companies can have fiscal years. Like I know at the company that I worked for prior to teaching full time, we were on a fiscal year of July 1 through June 30th. And a lot of schools actually do it that way too, to coincide with the school year, right? The school year kind of always starts in August and then ends in April or May or whatever, right? So a lot of schools will have a fiscal year of July 1 through June 30th. I know Lindenwood did for sure. I can't say if William Woods does or not, because I have not asked that question, although now it makes me want to ask it that I'm talking about it. But, so if you think about like retail organizations, they can have, and I think actually Walmart is on a fiscal year of February 1 through January 31st, right? And some companies might have a fiscal year of April 1 through March 31st, right? So a fiscal year does not necessarily coincide with a calendar year, but generally, it does cover an entire accounting cycle. It does cover 12 full months. It just does not necessarily have to be January through December, right? And so companies are able to use a fiscal period that better matches the way that their business runs and brings in revenue and things like that. As long as it is a 12-month consecutive period, it does not necessarily have to be a calendar year. Calendar year being January 1 through December 31. Fiscal year could be any starting point, February 1. If February 1's our starting point of our fiscal year, then it ends January 31st type thing, right? So just a difference, distinguishing between the difference of a fiscal year and a calendar year. Okay, so the accounting cycle, we've talked a lot about this. And we're seeing it here now. And it, again, just like it's showing here, these are the sequence of steps that we use to go through the accounting cycle. And I've mentioned before that, when we get to preparing financial statements, we get to step 7 of the accounting cycle, which we have already had practice with together, because actually, we can prepare financial statements after the unadjusted trial balance, right? That's what we've got practice with. We've got practice going till step 4. And from step 4, we can prepare financial statements, right? Because our financial statements are prepared from the trial balance, right? So that has all the information we need. Generally speaking, if a company closes its books every month, it's going to get to step 4, and then it's going to have some adjusting entries. Once we do those adjusting entries, we update the trial balances, right? We prepare that adjusted trial balance. So there's our second trial balance. And then from that adjusted trial balance, we prepare financial statements. And again, that's the income statement, statement of owner's equity, balance sheet, right? So if we're a company that closes our books every month we get to step 7. And those are known as interim financial statements, right? Because although they are the financial statements for that month, all of the months are going to combine together to make our annual kind of final financial statements, right? So monthly financial statements, quarterly financial statements are considered interim financial statements. They contribute to the whole of the year, right? We do our kind of our finals or our annuals at the end of the year. So every month we get to step 7. And then at the end of the year, we do step 8 and step 9. You'll see step 9 is another trial balance. That's why I've mentioned in class before, we do 3 trial balances in the accounting cycle. And then step 10 is for reversing or correcting entries if applicable, if needed, if necessary, right? So this is kind of just an optional. There are actually 9 steps of the accounting cycle, but if something needs to be reversed out or corrected or, if an error was found or something like that, again, we'd have to do correcting or reversing entries. So we got through step 4 in chapter 3, and now chapter 4 again, starting on step 5. And then we're going to use this worksheet to then prepare the adjusted trial balance and the financial statements. So that's where we're headed. The worksheet, and again, we're going to get practice with this in class together. Basically, we start with the trial balance columns, right? So that those are our first columns, trial balance columns. And then next are the adjustment columns. So these are any of the accounts that need to be adjusted. And this isn't going to be every account, but I did point out some of those accounts that are common adjusting entries, like supplies, prepaid insurance, prepaid rent, accumulated depreciation, unearned revenue, some of those, right? And then any accounts that get adjusted, we have to get an adjusted balance, right? So that's the adjusted trial balance. And then from that adjusted trial balance, we prepare income statement, and then we have our balance sheet and equity accounts. And so that's what we see on the last 2 columns. So this is considered a 10-column worksheet because, again, we're starting with 2 columns for the trial balance, 2 columns for the adjustments, 2 columns for the adjusted trial balance, 2 columns for the income statement, 2 columns for the balance sheet. So 10-column worksheet. Although, to be accurate, we have a column for account name too. It could be 11-column worksheet. Anyway. All right, here's an example of what that looks like. And so, again, we've gotten to this point, this kind of green shaded area here. We've gotten to this point, the unadjusted trial balance. And so we see accounts here, their balances, whether they're debits or credits. We make adjusting entries as necessary. You can see that not all accounts get adjusted, but we make adjusting entries as necessary. And then we prepare the adjusted trial balance to update all of those balances in the accounts after the adjusting entry. So I'm not going to go through every line here, but we see, for example, cash had a debit balance of $42.75. There were no adjustments made to cash, so it still has a balance of $42.75. And cash is a balance sheet account, right? That's an asset. So then that leads over here to our balance sheet columns, 4275. Okay, accounts receivable had a 0 debit balance, right? Accounts receivable has a normal debit balance, but it was 0 right here. And then apparently we billed a customer for services performed. So we see the debit to accounts receivable in the adjusting entry, credit to consulting revenue down here. So now that we've debited accounts receivable, it has a debit balance of $1,800, and that flows to our balance sheet columns, right? AR is an asset that flows to our balance sheet. Okay, supplies has a balance here of $9,720. We adjust this account down for the supplies that have been used. So it has a debit balance. We credit supplies for $1,050. And that takes it down to a debit balance of $86.70. And again, supplies is an asset, so that's found on the balance sheet, $86.70. So again, with this worksheet, we're doing our adjustments. We're updating the balances of those accounts. Any accounts from here that belong on the income statement are shown on the income statement. Any accounts up here that belong on the balance sheet are shown on the balance sheet or statement of owner's equity. And as we know from doing our journal entries together, hopefully at this point, is that for every debit, there has to be a credit, and the amounts have to be equal. So whatever our amount of debits, if we have $1,000 in debits, we have to have $1,000 in credits too, right? So the amounts have to be equal. So for every debit that you see here, there's also a credit. So again, for AR, the debit 1,800, the credit is to revenue down here, 1,800. For this adjustment to supplies, we see the credit to the asset that reduces the asset, letter B, 1,050. That's a debit to supplies expense. So that adjusting entry is a debit to supplies expense, a credit to the supplies asset account. This letter A, which is an adjustment to prepaid insurance, there is a debit to insurance expense. So we're debiting insurance expense, crediting prepaid insurance, right? So for every debit, there's an equal credit, right? Debits and credits have to equal. All right, so doing these adjusting entries, we're going to walk through and look at examples of kind of the four categories of adjusting entries, and it shows it to us here. So prepaid expenses, these are like prepaid insurance, prepaid rent. Supplies is also considered a prepaid expense because we purchase an amount of supplies at a time and we use those up over time. So we're prepaying that supplies expense. That's also considered a prepaid expense. Unearned revenues, again, I mentioned this is a common adjusting entry because, over the course of time, we earn some of those revenues. So we have to adjust it out of unearned into the earned account. And then accrued expenses, accrued revenues. Now, these adjusting entries should look familiar to you because with accrued expenses, what we're doing is we've incurred the expense, we just haven't paid it yet. So we've done a few of these together when we've went over our journal entry. So this is where we debit the expense, we credit accounts payable, for example, so accrued expenses. And then accrued revenues, again, this one should look familiar to you because what we're doing with accrued revenues is we have earned the revenue, but the customer has not yet been billed. So we send them a bill, we got to wait to get paid. So that's a debit to AR, a debit to accounts receivable, a credit to revenue. So we've done ones like that before. So some of these will look familiar to you. Okay, so with prepaid expenses, to adjust this account, we're going to, just like we see down here, debit the expense, credit the asset. Right? So when we adjust prepaid expenses, we debit the expense, we credit the asset. And so when we think about like prepaid insurance, and we had a prepaid insurance, journal entry in our transactions. When we purchase prepaid insurance with cash, we're debiting prepaid insurance, crediting cash. And so then when we have to adjust this account, we're debiting insurance expense, crediting prepaid insurance. And so we see an example of that here. It says the prepaid insurance account has a $5,000 debit balance to start the year. A review of insurance policies and payments shows that 1,000 of unexpired insurance remains at year end. So we had 5,000 worth of insurance at the beginning of the year. Now we get to the end of the year and we only have $1,000 worth of insurance left, right? Because as the year has gone on, we've been covered by that policy. That policy has expired with the passage of time, right? Our benefits to that have expired or have decreased with the passage of time, right? So we see that adjusting entry here, debit to insurance expense, credit to prepaid insurance. And so with this adjusting entry, we're increasing the expense, decreasing the asset, right? Remember, expenses increase with the debit. So we're increasing the expense. We're increasing the part of the policies that has been used up or has expired with the passage of time, right? We're increasing the expense, what's been used, and then we're decreasing the asset. So when we do this adjusting entry now, it's taking it from a balance of 5,000, then we adjust it for 4,000. Now we're at a balance of 1,000 like we should be, right? This one is an example of a supplies adjusting entry. So it says the supplies account has a $1,000 debit balance to start the year. Supplies of 2,000 were purchased during the current year and debited to the supplies account. A December 31 physical count shows 500 of supplies remaining. Okay, so we started with 1,000. That was our beginning balance. We started at 1,000. We purchased another 2,000. So then at that point, we had 3,000 worth of supplies, right? Through the year, we had $3,000 worth of supplies available for us to use. Now we get to the end of the year. A December 31 physical count shows 500 of supplies remaining. So we had 3,000. Now we're down to 500. We need to adjust this account for 2,500. That's the amount of supplies that has been used, right? So then we're debiting the expense, debiting supplies expense, crediting the asset. Again, we're debiting the expense for the amount that has been used. Expenses increase with the debit, right? So we're debiting the expense for the amount that's been used. We're crediting the asset. So that reduces the asset. It takes it from the $3,000 balance that our account, ledger account showed down to the $500 balance that it should show, right? Because we've used up 2,500 of those supplies. All right, here's another example. This one is of accumulated depreciation. So it says the company has only one fixed asset equipment that it purchased at the start of this year. The asset had a cost of $38,000, had an estimated life of 10 years, and is expected to be valued at $8,000 at the end of its 10-year life. So that formula, which I know we haven't went into this formula a lot, so this is new to you. But this formula that we use is the cost of the asset minus salvage value divided by the number of years, right? So we do not depreciate this salvage value. Is expected to be valued at $8,000 at the end of its life. So that's its salvage value or residual value, the amount that it'll be worth even when we're done with the asset. So we don't depreciate that. So we subtract that out of the numerator. So we take the original cost of the asset minus accumulated depreciation, or original cost of the asset minus the salvage value divided by the number of years. So we're going to depreciate $3,000 per year on this asset. So we are debiting the expense, right? Expenses increase with the debit. So we're debiting depreciation expense, crediting accumulated depreciation. Okay, unearned revenues. Again, this is when a customer pays us in advance. And so throughout the month or throughout the quarter, whatever the time period is, throughout the time period, we earn some of this. And so we adjust this account by debiting unearned revenue, crediting revenue, right? So if a customer prepaid us, say $2,000, and when we do our adjusting entry, we've earned 1,000, right? Then we're going to debit unearned revenue, credit revenue. So we're moving it from that unearned ledger account into now the earned revenue account, right? So here's our example of that. It says the company charges $100 per month to spray a house for insects. A customer paid $600 on November 1 in advance for 6 treatments. which was recorded with a debit to cash and a credit to unearned services revenue. At year end, the company has applied 2 treatments for the customer. So initially, they prepaid us $600 on November 1st. And just as it shows us that, as it tells us rather, that journal entry would have been a debit to cash, a credit to unearned revenue. So we see the credit balance and unearned revenue here. And so now we get to December 31st, and we sprayed their house in November for bugs, and we sprayed their house in December for bugs. So we've earned 200 of that. So we have to adjust this account. So we're debiting unearned revenue, crediting revenue, right? We're just moving it from that unearned ledger account into our earned revenue account. Okay, accrued expenses. Again, these ones should look familiar to you because we've done a few of these journal entries together before. In this example, we have incurred an expense, but we haven't paid it yet. So we're debiting an expense. We're increasing our expense that has been incurred. We just haven't paid it yet, so we're crediting a liability account, probably accounts payable, right? Salary and wages payable, maybe in this example. So this one says at year end, salaries expense of $5,000 has been incurred by the company, but is not yet paid to employees. So this is probably one of those examples where year end, December 31st, maybe it falls on a Tuesday. And so we have to record the salary and wage expense that has been incurred and earned by employees up through that point, but they're not going to be paid until Friday. So it's just going to go into this payable, this liability account until payday, basically, right? So the employees have earned $5,000 of salaries. The company has incurred $5,000 salary expense. So we're debiting the expense. Salaries expense, expenses increase with the debit. So we're debiting the expense, but we haven't paid it yet. So then we're crediting a liability account, in this case, salaries payable. That's a liability account. Liabilities increase with the credit, right? All right, accrued revenues. Again, these should look familiar to you because what we're doing in accrued revenues is we have earned the revenue. So we have provided the product or the service to the customers, but they haven't paid us yet. They haven't been billed yet. We have to send them a bill or send them an invoice. We've got to wait to get paid. So then in this case, we are debiting a receivable account, usually accounts receivables, crediting revenue. So this one says at year end, the company has completed services of $1,000 for a client, but the client has not yet been billed for those services. So again, debiting accounts receivable, crediting revenue. So we've done several really like that together already. So hopefully that is no surprise to you. Okay. So again, completing this worksheet, and we kind of looked at this with the example of the worksheet. So first, we have to come up with those trial balance columns, right? Fill in those trial balance columns. And then we do our adjusting entries, and we complete the adjustment columns. And once we have all of our adjustments, then we can update the balances in the adjusted trial balance columns. Once we have all of our balances updated in the adjusted trial balance columns, then we can, whatever of those accounts and balances belong on the income statement, copy and paste them to the income statement columns. And whatever of those accounts and balances belong on the balance sheet or the statement of owner's equity, then we copy and paste those to the balance sheet and equity columns. And then once we do that, we can determine net income or net loss, and we need this number in both the income statement columns and the balance sheet columns to hopefully get them to equal, right? And so we see an example of that here, and I am just going to try to blow this up a little bit. So You know, again, we see these are our trial balance columns and their amounts. And again, we made sure that debits equal credits. Step 4 of the accounting cycle, right? And so then we do the adjustments. That's step 5 of the accounting cycle, step 2 of this worksheet. But we do our adjusting entries. And then we update the T accounts. We prepare this adjusted trial balance. That's step 6 of the accounting cycle, step 3 of this worksheet. And then from there, any of these accounts, namely revenue and expenses that belong on the income statement, get transferred over here, copy and pasted, if you will, to the income statement. And any of the accounts, assets, liabilities, equity accounts that belong on the balance sheet or the statement of owner's equity get transferred over here to the balance sheet or statement of owner's equity, right? So that's what we're doing with each of those. And so we see, remember on our income statement, revenue minus expenses equals net income. And so we see here revenue 23,320 minus expenses 6,520, 6,524. Revenue minus expenses equals net income. So that's our net income here. Revenue minus expenses equals net income. And then we see that same number over here, because if we think about the statement of owner's equity, we take that net income and then we add it to the statement of owner's equity. So then we're also adding that net income over here on the balance sheet as part of equity to get these to balance. Anyway, we're going to get practice doing it together, and it's not too bad, I think. Okay, come on. All right, journalizing the adjusting entries. We just looked at examples of doing the journal entries, doing the adjusting entries. And again, that revenue, or excuse me, that, well, it encompasses revenue recognition principle and the expense recognition principle. But overall, the matching principle just tells us that revenues earned in one period are matched with the expenses associated with that revenue. So, you know, again, we have to, revenue recognition principle, we have to record revenues when the revenue is earned rather than when the customer pays us. So that's why we have that accounts receivable account. And then likewise, we have to record expenses when they're incurred rather than when we actually pay them. That's why we have those payable accounts, right? Accounts payable or salary wages payable, right? So those are, you know, following those generally accepted accounting principles. Once we complete the worksheet, again, from that worksheet, we can prepare our 3 financial statements. We saw examples of these financial statements in chapter 2 as well. Income statement, statement of owner's equity, balance sheet. So here's an example of our income statement, and this is based on that worksheet we saw a couple slides ago. So revenue minus expenses equals net income, 16,796. And remember that net income flows to our statement of owner's equity. So statement of owner's equity, we take beginning balance. This was 0, must have been the first month of operation. So then we add owner investment, we add net income, we'd be up to $111,996, and then we subtract withdrawals, and that gives us our ending balance, right? And so that ending balance in owner capital from the statement of owner's equity flows through to our balance sheet. And remember, our balance sheet, assets equals liabilities plus equity. The only kind of difference in this balance sheet that we're seeing from our previous balance sheet is, again, now we are depreciating this equipment. And remember, I said that as we depreciate that equipment, the book value of the asset goes down. So this equipment had an original cost of $51,300. We've just accumulated depreciation of $512. So $51,300 minus $512, book value of the asset is now down to $50,788. And again, that book value will continue to decrease every year as we depreciate more of the asset. All right, and then this last part of the chapter is introducing us to just a couple little variations on our income statement that we've looked at. So on this one, when there's more than one revenue account, and then also when we have a net loss as opposed to a net income. So, you know, they're both pretty basic. I mean, when there's more than one revenue account, we list them individually and then we do a total revenue line. I've said that a couple times in class together, right? And then when we have a net loss, what that means is that our expenses were greater than our revenue, right? So, I mean, just to make the math easy on me, if we had revenue of 1,000, but our expenses for the month were 3,000, we had a $2,000 net loss, right? Our expenses were greater than our revenues. So that's what we're seeing in this example. So we've got total revenues, $4,136. We've got expenses, $64.68. Again, revenue minus expenses. In this case, because expenses are greater than revenues, we have a net loss, a negative number, right? All right, and then this is a 10-column worksheet that we're going to get practice with in class together. I guess I could go ahead. Yeah, it's connected to my work desktop, and I am on my personal computer doing this. So it's not pulling it up, but this is a 10-column worksheet that we'll get practice with in class together. So as always, once you have a chance to view this recorded lecture, please let me know if you have any questions, and we will start on chapter 4 next week in class together. Bye-bye, guys. Have a great day.